Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and I'm speaking today with Jordan Roy-Byrne, founder and editor of The Daily Gold. We'll put a link to thedailygold.com down below this interview so you can follow along with Jordan's work. And Jordan, we're back together again, and once again, gold is just below $2,000 in the 1980s. Silver is above $24. Having a nice little bounce today on a Thursday. We normally record these on Wednesday, but here on Thursday morning, the interest rates are pulling back a little bit, the dollar's pulling back a little bit, and one of the news blips of the day is that we have seen a rise in the weekly jobless claims. They jumped up to 1.5-year highs today. So that's probably responsible for some of the short-term economic news. But just in a general sense, when you look at the gold price, when you look at the silver price, not much has changed. How are you seeing it set up technically? Any takeaways from gold or silver where we're at today?
Yeah, I think the setup for both really, but let's focus on gold since gold drives silver as well. You had this, I don't want to say it was a distribution top, but on the weekly and monthly chart, you do have some concerning candles right around resistance. And so that, gold fell below 1980 on a weekly basis. So it's kind of had a little bit of a breakdown there. It's rallying a little bit. More than a little bit today on that news. But I think even if you're a bull, like let's say you're a bull and you think that this is going to break out in the next month or two or three, I think even in that type of outcome, you're still going to see, I think, a lot of back and forth moving forward. For me, I've talked about there's real significant long-term support around the mid 1800s. You also have an open gap at, I think, 1867 is what it goes down to. So I would not be surprised to see gold come down and trade below 1900. But in the bigger picture, if you tell me gold is not going to go below 1850, that to me is really, really bullish. I know I'm getting ahead of myself here, but looking out, that's what the setup is that if we see more weakness in this market, it could come down and, perhaps make a really bullish bounce from that support of the mid 1800s. You get that. You get some strong weekly candles after that bounce, and the setup is going to look much better than it looks right now, and the price could honestly be around the same. So that's something I'm looking at. I would be really surprised if gold was able to break out sooner than that, just because the bigger picture macro, the stock market has broken out, and so people are getting excited about the stock market again. Positioning in the stock market has been not bullish at all. And so I think a lot of, capital investors and, managers of capital and all those sorts of people, they've been underinvested. So you could get some of them chasing this move, which has been led by so few stocks. Now they're starting to go into the other stocks. I think that's a bit of a catch-up move. So that's basically how I think the macro is playing out here for precious metals, that in the immediate sense, you have some more optimism in the stock market, and people are thinking, well, maybe this recession is not going to happen, or maybe it's going to be delayed for a while. And so that's kind of the driver, in addition to people being underinvested, of the S&P having this little breakout here. And, at the same time, that's why gold was unable to break out. So I think that's where we are in the bigger picture. So these little daily moves back and forth are not really that significant for me. I'm not seeing anything in the charts yet that tells me, we're coming to something important here in the very short term. But for gold, it all comes back to the macro fundamentals and the economic drivers, and how soon we're going to get that recession, and how soon the Fed will be forced to shift policy. And that's really the focus. And who knows, maybe if we get a couple more weeks of like continuously bad economic data, that's something that could really strengthen the outlook for gold here and maybe prevent it from falling below 1880 or 1900.
Yeah, if we had something else come up economically that was a wobble point, that may at least put a floor under gold so that it corrects through time more so than price. But it sounds like over the next couple weeks or months, you wouldn't be surprised to see a lower price in gold and the yellow metal, and that there is some strong support down there in the mid 1800s, as you've outlined before, at some of those key moving averages. Well, when you talk about the macro fundamentals and things lining up, we have a Fed meeting next week, Jordan, where a lot of the market is position that they're going to possibly pause. There are still some folks now starting to bet on the fact that they could do one more hike, but there's a lot of people that think they may pause or what they call a skip for the next meeting and then hike at the very next one. But either way you slice it, it'd be the exact same outcome. If you hike now and pause the month after, or if you pause now and hike the month thereafter, there's still only about one more hike in the chamber for the Fed. And the news about the jobless claims going up is something the Fed will be watching, but I don't know there's any economic data points that's going to cause a radical reaction in the next month or two where they're going to start to suddenly cutting rates unless something comes from out of left field. So for right now, we've got the same kind of economic picture we've had for a while where we're just waiting for this to wrap up. We're going to have to go through this period where that we have higher rates for longer. And to your point about people piling into the general stock market, as people get excited about AI and general markets getting a little bit better breath, where some of that money that was piled into the big mega cap tech stocks is starting to filter into other sectors, the smaller growth tech. It's starting to filter even into some of the most beat up sectors like Cathie Wood's ARK Innovation Fund, or it's getting out into even the Russell 2000 that was getting beat up, got a little life to it recently. So all things considered, when you look at intermarket analysis, what do you think needs to happen over the second half of this year to really give precious metals the boost in relation to the general markets and in relation to the macro?
A recession. That's my one word answer. A recession. I mean, you get a lot more weakness in the economy. The market is going to forget about inflation, and attitudes are going to change from worrying about inflation to worrying about recession. I mean, obviously they're worrying about both, but when worrying about recession becomes the dominant theme, and you'd see the S&P roll over, because typically when the recession starts, now it's difficult to tell you in real time, but when the NBER goes back and they pick the dates of when the recession started, the stock market tends to peak like a month or two, or make a peak a month or two before the recession starts, and then it has a pretty big decline over the next 4 months, sometimes 5 or 6 months. And so if we see the stock market like suddenly reverse course and then it makes a lower high and then rolls over hard, that's a signal that a recession could be starting. So I think that's fundamentally it's a recession. And if you see weakness in the stock market, like I just described, those are going to be catalysts for gold, because at the same time, you'd see bond yields really plunge and the market would start aggressively pricing in cuts. That's just what it comes down to for gold. I mean, it's just a waiting game. Technically, in the very big picture, gold's in a very bullish consolidation. I mean, it's holding well above the 38% retracement, which I think is 1675. So giving it a bird's eye view, like gold has held up really, really well. Like if you look at where real interest rates are, I mean, they've gone up significantly. They haven't even rolled over yet. And gold is like $100 away from a new all-time high. It's like 5% from a new all-time high. You look at this setup, it's just in the very big picture, it's really, really bullish for gold. But the problem is that doesn't mean it's going to break out here in the next month or two or three. So it's just going to require some time. We are going to have a recession. It's just a question of when. I think the question is not, well, are we going to have a recession, or is it a soft landing? The negative for gold is not the possibility of a soft landing. It's really that the recession gets delayed and say like, well, maybe it doesn't happen until Q1 of next year. Like that's the negative for gold, where it could just, continue to do nothing for another 4 or 5 or 6 months, before it would make a huge breakout with the recession beginning. So that's what it comes down to for gold. Because if the stock market, like if this move in the stock market has some legs, then that's more money that's coming out of precious metals and going into the equity market. That means a tighter Fed, and that also means bond yields are moving higher, which also means a stronger dollar. So it's all linked together. And, that's what's affecting gold negatively here, as far as the last month or so. And I think that stuff will continue for at least a couple more months. And again, the risk would be that stuff continues for another like 4 or 6 months. I'm not making a prediction on that. I'm just trying to set up the larger situation. Like that's the negative. But, the positive would be that the economic data, it suddenly just becomes all negative. Like everything that comes out this summer, like every report, doesn't necessarily have to be terrible, but just everything is trending down, everything's negative or getting worse. Then the market, the stock market would start to fade, bond yields would come down, and the market would be, moving up those rate cuts. So at least that's my picture for how the setup is for the macro and how it can impact precious metals here for the summer and the rest of the year.
Makes sense, Jordan. So we may still just have to wait for a little while and people have to be patient and let this period play through. Maybe kind of a boring period where things go sideways, or it could be a weak period where things just sell down until we see a shift in the economic data, a shift in the Fed's focus, a shift in the general stock market. Another topic you've been discussing in some recent interviews and something we've talked about before, but it kind of goes along these same lines, is if we get that recession in the second half of this year, or even if it gets pushed out to the beginning of next year, either way, it's going to be a contracting economy. And you've been making the point quite a bit lately that this is a time to be looking at gold and gold related equities, not so much looking at commodities. So when you think about, the commodity sector being so dependent on economic growth, you're not a huge fan of getting into copper or uranium or oil and gas and things like that at this period of time, even though you're bullish on those longer term. I'd love you to unpack that concept, because a lot of people like being in a diversified basket of commodity stocks, and you really see the advantage being in the precious metals over the commodities at this period of time.
Well, if you study history, there's a commodity cycle. And usually, I mean, there are some periods in secular commodity bull markets where everything is rising together. And I mean, we will see that again at some point. But it's important to understand the macro and macro market action and how that impacts the various commodity groups. And for the last 6 or 7 years, we're in this situation where, there's some worry about economic weakness, or there's a softer Fed, where the Fed has to cut rates, that type of thing. And at the same time, inflation expectations are declining. That's when gold outperforms, then silver outperforms after that. Then when you get a low, inflation starts moving up and you have, stronger economic data and more economic optimism. That's when commodities as a whole will outperform precious metals. And that's what we saw in 2020. And remember, in 2021, 2022, at least in the beginning of 22, copper and the other commodities were outperforming precious metals. So remember, energy is typically a late stage play. And so if we're going into recession, as I think we are, and if you hold that view, you want to be focused on precious metals, not the other commodities. I mean, a time will come for the other commodities, but if we're going to a recession, you're probably going to see lower prices in those other commodities, and you'll have time where you can really wait for those to get to a better entry point with respect to, when is the economy bottoming out and looking like it's going to turn higher, and inflation is looking like it's going to turn higher again. Now, if you really favor things like copper and uranium, then you should probably have the view that if there's a recession, it's going to be really mild and it's not going to last that long. And that's the macro view for owning those assets, like right now. I mean, yes, there could be a recession, but it'll be a very mild one. And so maybe those assets won't get hit that much. And so it's okay to hold those and hold the companies through that. But if we're going into, I don't want to say a nasty recession, but it's not a mild recession, that's negative for commodities as a whole. I mean, that's bullish for precious metals, first and foremost. And you can just look at the ratio charts, and gold has broken out. It's outperforming. It's in uptrends against copper and all those other commodities. So I would just understand that you should have a macro viewpoint with respect to which of these commodities you want to own right now and be overweight, because they outperform at different times. And at least, for me, when I'm looking at the charts right now and I'm looking at the macro, that tells me that precious metals are the best play now and are going to continue to be the best play for the next year or two.
Well, and Jordan, between gold and silver, I would imagine that silver falls into the camp where it has that industrial component like some of the other commodities, but it also has the precious metal and investing side, which is what really moves the pricing, is the investor demand. it will track gold in general, but would you be more weighted to gold over silver right now for the initial move and then over time filter back over to silver? How would you see those two relating?
Yeah, that's a really good question. It brings up some important points. So typically, historically, all these huge moves in gold and silver, typically gold breaks out first. It breaks a key level, and then silver, whether it's 2 months after or 6 or 7 months after, silver breaks its key level. So gold is going to break 2050 or 2100 first, and then that tells you that silver is going to follow and break above, 28 to 30, that area. So I'm underweighted in silver right now, but I would focus more on silver when it looks like gold is going to break out, or when it does break out. You'd probably have to buy it a little higher than it is here, but at that point you would know that it's getting ready to really outperform gold. So that's how I look at silver. The other thing, and you made an important point, silver is an industrial metal. Gold being consumed, it's like a tiny percentage of its demand. Silver being consumed, I don't have the figures in front of me, but I think it's like 40 or 50% of silver is consumed. So it is an industrial metal. However, silver trades like a beta play on gold. So the industrial stuff it's like meaningless for how silver trades. I mean, if you're making an investment case on silver, it's all based on gold. So the stuff about like demand from solar panels or batteries or whatever this new stuff is, it's completely meaningless to the silver price. It's all, how is gold performing? When gold performs well, that's when silver is going to really move. It's a beta play on gold and nothing else. And so you made the right point there. I mean, and it's the same thing with gold. It's investment demand. That's the only demand that moves these markets. It's the marginal mover. Like all the other demand is really meaningless as far as the price. It's investment demand for gold and silver. And when real interest rates are going to decline and the stock market, is going to roll over and economy is going to a recession, that's when investment demand is really going to pick up for gold. And then when gold breaks out, then investment demand really starts picking up for silver. And then that's when silver breaks out.
Yeah, Jordan, 100%. It's really price discovered at the periphery, and the periphery where price is discovered is where the investment demand meets that. It's not really who's ordering the most solar panels for next year, although that's important and it's a factor. It's the price is what's moved on the futures market, and everything else responds in that sense. That's the investor demand coming in, as well as the coin demand and the bar demand. But really, it's the futures markets that's pushing the needle on these things. And that's true of a lot of commodities. It's really the investment demand that pushes it around. So just as we wrap up, it sounds like we're waiting for the macro fundamentals to change, not just in the economy, but also how that relates to the stock market, waiting for a breakout in gold. We're waiting for the commodity sector, maybe a little bit longer than the precious metals. But when you look at the precious metal stocks, and if you were focused on the gold stocks, is there a particular area of them that you're most focused on? Is there an area of the gold stocks, the explorers, the developers, the producers, the royalty companies, the prospect generators? Which ones do you really think will have the most beta to the sector when things take off?
Well, not the prospect generators because they don't have any gold. But I would say producers. I think junior producers that have growth potential, those are, it's hard for me to make a one sentence answer without droning on, but junior producers, that I think would be the focus. Because the thing about junior producers, and the ones that are well capitalized, and also, I mean, if you like explorers and they're well capitalized, I think that's fine. Because if these companies are well capitalized, and let's say there's a scenario where the recession doesn't hit for like 9 months, and these companies have cash and they're making cash flow, they can get through that period without being forced to raise again and dilute current shareholders. So those are going to hold up better in that situation. They're also going to be the first ones to move when precious metals break out. And look, even if I'm wrong and gold is able to break out here in the next like 2 or 3 months because the data just suddenly gets so much worse, and then it looks like the recession is going to, happen at the end of the summer. I mean, even in that scenario, the producers are going to move first and catch all the money first, and then if you get the confirmed move, then you can look at moving more into silver and explorers.
Okay, it's a good roadmap for people to follow and to think about in their own portfolios. Well, Jordan, we'll wrap it up there. We'll get together again next week and see how things have shifted, but that gives people kind of a short-term and a medium-term picture of what's going to play out in these markets and the key catalysts that we're looking for. Always appreciate you spending some time with us here at the KE Report. And if people like getting Jordan's thoughts and ideas, definitely click on the link below. It takes you over to the Daily Gold. Until next time, Jordan, have a great afternoon.
Thanks for having me.